Hi, Lacey Philippich here from Money School for day 20 of the 30 Days 30 Tips Challenge. Apologies for the building noise. I know you would have heard it in the previous videos as well, but we've got a construction site next door and it seems to be going on forever, unfortunately. I guess that's how it goes. I think it's a bit of a home job or mates rates. Anyway, today's tip is, what do low interest rates really mean? Now, this comes about because, of course, in the United States, they had zero interest rates for quite a long time. Now they've gone up to 0.25%. In Australia, our rates are at a record low of 1.5%, and they could go lower. There's estimates that that might happen when they go lower. Now, what does that mean? Low interest rates are an indication that our economy is not very strong. When interest rates drop, what's trying to be done by the central banks, the Reserve Bank of Australia in our case, or central bank, it might be in the US or Canada, is that they're trying to encourage people to borrow. And the reason they want that to happen is because borrowing, of course, puts more money into the economy, and then everybody makes more money, right? Because you're spending. When interest rates keep dropping, it's a sign that the economy is going slower and slower, and that they're worried about it. So what does that mean for us? It means that we should be cautious about overextending ourselves. Now, it is an excellent time to take on debt if you can afford it. If you have a steady, stable job that you're not likely to lose, for example, your own business, and it's a reliable income, or you're not very high up in a company, they might be chopping heads, that kind of thing, you're operating, you're maintaining, kinds of jobs that they can't get rid of, and you're not borrowing to your maximum capacity, because of course low interest rates sign that our economy is not going well. We might see prices drop in things like real estate. So it's not necessarily a great time to borrow unless you can really afford it. It is the cheapest money you're going to be able to borrow for a long time. Your long-term estimates, though, should still be based around 7 or 8% in Australia. What would the repayments look like then? They'll be more than double what they are at. Obviously, under 4% is what you would get as a retail rate for a loan right now. Now, the flip side of this is, of course, and this is answering Chandra's question, what do you do in an environment when rates might even go negative, and they have in some countries? In other words, you might give $1,000 to the bank, they actually take like $25 and you only get $975 back, just to make sure that the money is still worth something. That's a negative interest rate, and it is happening already. It's very hard to know what to do with investment in that case, because it certainly signals some people worrying about the economy. However, you can still buy shares that will do better than interest rates. So for example, you could buy shares in a bank that's very safe. You know, we've got 4 banks in Australia that would be considered very stable. We talk about them as our 4 pillars. And they would give you a dividend that's higher than the interest rate that you're earning, certainly higher than a negative interest rate. So you could consider doing something like that. I wouldn't do it with everything. I would do it with a portion of my income. And you could be buying diversified shares, so an indexed fund, for example, and doing the same thing, getting the dividend from that so you get some return. Ideally, if you don't need that money, reinvest the dividend and it will continue to grow. But we are in an environment where there is a risk of recession, which means growth stops. We get negative growth. So it's not necessarily the time that you're going to be making a lot of money. The aim is not to lose. Don't lose your capital, particularly if you're close to retirement. You have to maintain your capital. Don't do anything risky. Don't do anything crazy in the hope that you can do better than that, 2% return that you might expect on average across the globe at the moment. Don't go crazy. Wait it out. These are cycles. They will go. Don't lose your capital. Okay, if you enjoyed this topic, you might like the blog about, is it a good time to borrow? I actually wrote this a little while ago, over a year ago, but it's pretty true now as well. Hope you'll enjoy it, and I'll see you tomorrow for day 21. Bye.